And so I think it really makes a lot of sense that Adrian Orr is kind of sitting on his hands for the moment, forming a bit of a wait and see sort of environment, see how this plays out before even thinking about embarking on further rate hikes at this stage. You're already seeing the housing market, activity slowing somewhat. Prices are a little bit lower. And households are starting to feel the pinch. So we have seen, maybe 50% of households see their mortgages roll off very low interest rates and into higher fixed rates. But we've still got some more to come yet. People are really starting to feel that pinch just now, and it may take some time before they actually sort of slow up on their expenditure.
Yeah, Stu, but really quickly, because what I was actually asking is how soon until you think he cuts? Because every conversation I've had with Governor Orr, he's always been, we're going to move and we'll move quickly, whether it's one way or another based on the conditions. So do you think that, by the end of this year, we could see a cut coming through?
Well, if you look at the futures markets, that's what the market is pricing. I'm probably more of a strategist in working out where the market's pricing that right. I can't say that's wrong because a lot of the heavy lifting's been done. Not the heavy lifting, but essentially the easy moves in inflation have occurred. With oil prices coming down, food prices are coming down. Services inflation is remaining sticky, and as Mandy said, the unemployment rate in New Zealand is very, very low. So. The Reserve Bank's going to want to maintain a hawkish tone, and they will want to keep the market thinking that interest rates still need to go up at some stage. Certainly if that inflation proves persistent. But like I said, it's the consumers are starting to feel it in their pockets.
Sorry. What does this all mean for the stock market, Stuart?
Yeah, well, the stock market, I guess, has already adjusted somewhat to higher interest rates. The New Zealand market does have quite a high exposure to utilities, property, companies that aren't overly cyclically exposed, but they do tend to be used as proxies for bonds. Alternative bonds, in the past with low interest rates, that has been quite a good place to park your money and earn a decent return. And the New Zealand market has come off somewhat on a year-to-date basis. It's pretty flat, maybe 3 or 4% up on a year-to-date. So, for now, it hasn't been a great environment as those interest rates are rising. But if the market does start to, price in no further rate hikes and doesn't see bond yields a whole lot higher than where they are now, then I think some of those sectors will come back into favour, and the New Zealand market could do reasonably well.